Hey everyone, this is Scott here again with a new video to help you learn how to trade, invest, and master your finances so you can apply that knowledge in the real world and multiply your money. And in today's video, you'll be learning about volatility hedging, which is applicable to really any kind of portfolio, whether you have a stock portfolio, an options portfolio, a futures portfolio, or any combination of the above. You can use volatility hedging to protect yourself from very large market corrections and in particular, market crashes. And if that sounds interesting to you, then please do me a favor and hit the like button on this video and subscribe to my channel. I would greatly appreciate it. Now, very quickly before we get started, if you would like to take some in-depth classes on options trading, and stock market investing, then check out my courses on SKILLSHARE. I've been teaching on that platform for well over a year at this point, and in case you aren't aware, SKILLSHARE is a lot like YouTube, except the content on that platform is geared solely towards the purpose of education in the form of online classes. And in my courses, you will see a lot of the detailed research and analysis that I've done using real stock market data with spreadsheets, graphs, and even computer programs that I have written to help simulate and prove the concepts that I am teaching. And I dropped some links to some of the more introductory courses of mine in the description of this video below. Now, you will need a premium membership with the Skillshare platform if you do want to watch my courses. But if you do sign up for that membership using the links provided in the description of this video, you'll get an absolutely free 2-week trial. And during that time, you can watch all my courses on Skillshare absolutely for free. And then once your trial is over, it will only cost you a few dollars a month to maintain your membership, and you'll gain access to all the future courses that I have planned going forward, in addition to all the other classes that are on Skillshare too. And if you decide it's not for you, no worries, you can cancel before your trial's over and you won't lose a dime. But again, if you are interested, then check out those links below and join the thousands of other students that have already taken my classes. And so with that being said, we're going to jump on over to my trading platform now and we'll get things started. Okay, welcome to my ThinkOrSwim trading platform here, and what you're looking at is a 1-year price action chart of SPX, which is just the S&P 500 index. And so as I said in this video, I'll be showing you a technique that you can use that will hedge your portfolio against very large market corrections or crashes, especially crashes. And it all revolves around the implied volatility of, in this case, the S&P 500, or really any stock that's in your portfolio. Now, if you are unfamiliar with implied volatility, I do have a separate YouTube video explaining in depth what that is and why it's the reason that I only sell options, and I'll post a card above linking to that one so you can watch it. But just so you have some context in this video, implied volatility is simply the market's expectation of where a certain stock, or in this case an index, will be at some point in the future. It basically gives you an expected price range, either an up or down movement, either a week from now, a month from now, a year from now, etc. And the implied volatility for SPX in this case is shown down here in this graph. And I'll expand it up a little bit so you can see it better. There we go. So this shows you the 1-year history of the implied volatility for the S&P 500. And you can look up this same kind of graph or implied volatility metrics for any individual stock as well. And you can definitely notice here just how much the implied volatility changes across time. And as of right now, it's definitely on the lower end. The implied volatility for the S&P 500 is right around 21% or so. And when you do look up the implied volatility in your platform, it will typically be quoted on a 1-year time frame. So what this means down here is 1 year from today, the market as of right now is expecting the S&P 500 to either be up or down by 21%. So like I said, this is definitely on the lower end for the past year. And based on what's happening in the market at the moment, if there's a lot of fear in the market, for example, this implied volatility will definitely increase. So the implied volatility is also a way to gauge the level of fear in the market. Because for example, if you look at this zone right here, where the implied volatility spiked significantly, this was right before the presidential election back in November of 2020. And so of course there was a lot of uncertainty and potentially a lot of fear around who was going to be the next American president, and so that's why you saw the implied volatility expand like this. It got up to around 40%. So at this point, based on the heightened level of fear in the market, people were pricing in a potential down move in the S&P 500 a year from this day by around 40%. That's a very large move down. Now that being said, once the election was over, and we learned who the next president would be, at least in this case, all the fear pretty much vanished. And as a result, the implied volatility came back down to around 20% or so. So just because there is fear in the market for a time That does not always mean that something very catastrophic is about to happen. Sometimes people get fearful for whatever reason, and then I would say most of the time, things do get worked out in a non-catastrophic way, which then causes the fear to subside and the market to rebound or recover. And so now that I've mentioned that, if you look at this price action chart and you compare it to how the implied volatility moves, you will notice that most of the time when there is a significant spike in implied volatility, a significant spike in fear in the market, during this time the market usually sells off pretty hard. So this spike right here corresponds to this big down move right here, and this big down move corresponds to this spike in implied volatility, another big down move over here, and sure enough, along with this, you saw a very large spike in implied volatility or fear in the market, and so on and so forth. So there's a very high correlation between where implied volatility moves, where the fear in the market moves, and also where the market actually does move in response to that. And more often than not, it's to the downside, which should make sense. When people get scared, they usually sell off their assets, which causes more people to sell their assets, which in a chain reaction causes the market to go down significantly. And then as the fear subsides and people calm down, they start buying again, and that causes the market to recover. Now, if we do go to a larger time frame, let's go to the 5-year 1-day chart, and I want to focus in on this area right here. So back in 2020, back in February and March of 2020, I'm sure everyone recalls the huge crash that occurred because of the beginning of the coronavirus pandemic. And so this is the kind of move in particular that volatility hedging will protect you from. It will definitely also provide you some protection for large moves in general, but volatility hedging is most effective for extreme events, market crashes such as this. Because when you look at the implied volatility during this time, it got to basically near record highs. At the peak of the crash, the implied volatility for the S&P 500 got all the way up to above 80%. This was one of the highest points of fear and chaos ever recorded in the market. And if you just think about it conceptually based on what implied volatility means, an over 80% measure in implied volatility means that 1 year from this point, the market was expecting the possibility for the S&P 500 to be down by over 80%. Almost all the value in the entire stock market completely wiped out. Now, fortunately, that outcome never came to fruition. At the time I'm recording this video, we're basically 1 year from this market crash, and obviously the market is basically at new record highs. But obviously while this was happening, while implied volatility was exploding, the market was crashing by over 35%. And if your portfolio consisted of mostly long positions, or even if you were somewhat short on the market, for most people, and myself included, this huge down move was just too great. My portfolio was leaning short before this crash happened, and by the bottom of the market crash, I was down a lot of money. And so if you are fearful, particularly of another event like this happening sometime soon, which I would not say is too outlandish given just how far the market has gone since the bottom of the crash, right? I think many of us can agree the market is very, very lofty at this point, and I would not be surprised if we experienced another major correction at some point soon. So what you can do is you can actually buy volatility. You can allocate a portion of your capital towards consistently holding a volatility product. So for example, if we look at VXX, this is an ETF that tracks the implied volatility in the market. And so just like what you saw with the implied volatility on the S&P 500 chart, the price action of VXX basically mimics that. So back in 2020, when the market was crashing, VXX was absolutely exploding. It's just tracking the implied volatility in the market. And so given that this is just an ETF, you can just buy it. You can buy shares of VXX, you can buy calls on it, you can buy call spreads, you can sell put credit spreads. There are tons of ways to basically get bullish or get long on this kind of product so that if and when the market does come back down very hard and implied volatility or fear explodes once more, you could make a lot of money when that happens. Now, of course, if your portfolio is long, or like I said, even if it's a bit short and the market does crash again, chances are your portfolio by itself, not including any volatility products, your portfolio will be losing a lot of money. And so that's why this is mostly used as a hedge, because the money that you will lose with your portfolio will hopefully get made back either entirely or a bit less, or a bit more, based on your positions in volatility products. Now that being said, when the market did crash back in 2020, if you had, for example, bought and call options on VXX beforehand, chances are after this huge move, your portfolio as a whole, including your VXX calls, would have managed pretty decently well through the market crash. But markets don't crash very often, do they? So if this is something that you do want to incorporate into your trading or investing strategy, most of the time, this will create drag on your portfolio. And by drag, I'm referring to the fact that given that most of the time implied volatility is contracting, it's actually going down, you will be slowly losing money on your VXX calls or your VXX shares if you bought shares outright as time marches forward. So this is not something I would recommend you allocate a lot of your capital to, because you will be slowly bleeding money as the market just behaves normally and doesn't make any large down moves. And you can basically consider that drag on your portfolio simply as the cost of maintaining your protection. Protection is not free. It really never is in the market. But if you are fearful for whatever reason about a coming market correction, then perhaps allocating just a small portion of your capital towards buying volatility product call options or call debit spreads might be a pretty good idea. That way the drag on your portfolio would not be significant, and it would also give you the peace of mind knowing that you do have protection in place for the next big market correction or the next big market crash. And so that concludes this video. I hope you enjoyed it, and please let me know your thoughts or if you've got questions in the comment section below. And don't forget, if you want to take some in-depth classes on options trading, and stock market investing, then check out my courses on SKILLSHARE, links in the description of this video. And lastly, if you enjoyed this video, then please give it a thumbs up, drop a comment, and subscribe to my YouTube channel, and make sure those notifications are turned on. I'll be dropping new videos every Monday, Wednesday, and Friday, and you don't want to miss out. So thanks again for watching, and I'll see you next time.